So we're in a technical recession now, okay? And although some people might still deny it,
I will say that the textbook definition of recession is not 2 negative quarters of GDP.
yeah, I don't really feel that. I'm pretty sure we're in a recession. But people like Warren Buffett are the people that you need to look to whenever it comes to investing in a recession, because this is the #1 person that has been investing in the last 80 years. Now, Warren Buffett is chocked full of amazing quotes that he has said throughout the years because he's caught so much notoriety being one investor that has stayed true to what he really believes in. And one quote that stands out amongst any of the others whenever it comes to investing in a recession is, be fearful when others are greedy, but greedy when others are fearful. So in this video, I want to go over the top 10 rules that Warren Buffett has laid out that he stays true to while investing during a recession. So without wasting any more of your time, let's jump in right to rule 1, and that's staying away from debt. Whenever you're talking about investment loans such as margin, it's very important that you stay away from this during a recession because debt can magnify losses. But Warren Buffett's simple quote says it best. There is simply no telling how far stocks can fall in a short period. Even if your borrowings are small and your positions aren't immediately threatened by the plunging market, your mind may still become rattled by scary headlines and breathless commentary. He also added that an unsettled mind may not be able to make good decisions. We simply will never know how long a market crash can last, and so staying away from debt is so important so that we can increase our survivability in the market. But now on to rule number 2, that's investing for the long term. Trying to time the market has always been a very risky event, but even during a recession, it's even that much more important that you try not to do so. If you were waiting for stocks to hit an absolute rock bottom, you could wait too long and actually miss a lot of the great days that are already started during the recovery of the stock market. And when Warren Buffett was asked what the likelihood of him being able to pull off such achievement of buying the bottom, he said it would be like trying to time it with a clock that has no hands. Warren Buffett also says that you should not pick stocks that are also just depressed in their stock price because we're in a recession. Any sort of bad economic news could take these small companies out from underneath them. In fact, you should invest in strong companies that you think have a competitive advantage with some strong sort of, long-term competitive moat to them. That way you can still take advantage of, lower costs because we're in a recession, but also that they will have survivability through this recession. And that leads us perfectly to rule number 3, which is don't sell your stocks just because they're down. There are plenty of reasons to sell during a recession. There are companies that can fall under bad times that might not ever be able to recover. But just because someone is putting a low price on a strong company does not necessarily devalue that company in any way. Remember that a stock price is only investor sentiment, okay? So it has nothing to do with the actual future value of the company's earnings. Warren Buffett talks about how stocks that have actually decreased in value can actually be looked at as a true blessing. If you're going to buy that stock anyways because you believe in the strong fundamentals of the company, it's like going to the grocery store and not buying your favorite foods because they're on sale. If you like them and that's what you wanted to get, then go ahead and buy them if you truly do believe in the company and you've done your research. But now for rule number 4, this is diversification, okay? Something that Warren Buffett himself doesn't necessarily follow, but also none of us really have the time that Warren Buffett does to put all of our time directly into just the stock market, right? Other people have other jobs or other hobbies that they like to do, like YouTube. An important step to taking advantage of downturns is diversification, because you don't necessarily have to focus on individual companies that could go bankrupt due to unforeseen things that you might have not put 100% of your time into researching them. It is true that you can be very well compensated for picking an individual company that does extremely well during a recession. That is exactly Warren Buffett's plan. But he also has hundreds of thousands of employees that are focusing on a mere 30 to 40 stocks that are in his portfolio. For the very broad public, Warren Buffett still tells you to invest in broad indices like the S&P 500. Rule number 5 is not to watch the market very closely. Now, this may not sound like a big point to some, but this is a huge point for Warren Buffett because the psychological effects that a red market can have on an individual person. Instead of Warren Buffett just looking at whether his account is up or down just a few percentages each and every day, instead he reviews his current investment strategy to see whether or not it still fits into today's, environment for him to be able to invest for the long term. Then it's all about patience and letting the long-term process do what it should and help you make some money for the long term. Warren Buffett even goes on to say that the only time that he actually cares about what the stock price is whenever he's going to actually buy the stocks, which is so important because that's when the actual sale could be made. But now going on to rule number 6, we have dollar cost averaging. Now, dollar cost averaging is the idea of putting either equal or different sum payments over the course of whether every week or bi-weekly or monthly, but not in a single lump sum. Now, this sort of helps out with every other rule that we've already spoke about. And the idea that we are so bad at timing the market that we have a clock with no hands is the same reason why dollar cost averaging is more important than just lump summing it into, the wrong time to invest into the market. Plus, it's a proven statistic that spreading out your investments helps your overall returns in the stock market. Continuing to make regular contributions, especially during a recession, is so important to make sure that you can actually take advantage of these prices being down while we're in this recession. So try to set aside as much as you can afford and diversify while doing so is the best overall strategic investment plan for you to get the most out of this recession. Warren Buffett, for example, is already taking advantage of these great decreases in the prices of stocks this year with pouring in over $45 billion to buy more stock in just the last 6 months. And going on to rule number 7, that's don't try to day trade a recession. Studies done by Charles Schwab showed that active traders significantly underperformed low-cost index funds that have performed over the last 6 years. Now in a recession, while the market is going down, there's more likely that the chance that each individual day will be negative days versus positive, especially whenever we're in a bear market. And buying and selling stocks during this time only furthers to eat away at your portfolio whenever you start to add fees and taxes into the mix. And just because Robinhood can offer you $0 commission trading does not mean that you're not getting an actual spread whenever it comes to the value of the stocks that you're actually buying. This is called payment for order flow. It's how they actually end up making money off of you. If you continue to buy back and forth, you're taking a little cut out of your investments every single time that you want to purchase an extra stock. But going on to rule number 8, and this one seems to be the hardest for the average investor, and this is avoiding the herd mentality. One fact that has been well documented across a lot of studies is the fact that the average investor underperforms the S&P 500. Warren Buffett did a famous long-term bet that actually proved this over a 20-year period. And one major reason for this is just the idea of herd mentality, right? As the stock market starts to go green and there are the hottest stocks that start to blow up, people pour higher and higher amounts of, their large amount of savings into stocks that have already gained a huge amount of momentum. Then, whenever a crash comes, they're the same investors that because the stock has actually just started to turn red, that now they think that it's a bad investment and then they will sell off. Way too many investors buy high and sell low. The exact opposite of what the actual goal of investing is even about. Warren Buffett has another amazing quote on this. He said, "The most important quality for an investor is temperament, not intellect. You need a temperament that either derives great pleasure from being with the crowd or against the crowd." In other words, that means keeping your eyes on the prize of that long-term goal instead of just going and getting distracted by the noise that could take you away from the overall objective. But going on to rule number 9, and that's the idea that an overall crash is not a bad thing. No one enjoys watching a crash happen while it's happening, right? Even in 2008, Warren Buffett considered selling because things were getting that dire. Thankfully, though, he didn't sell. He remembered the one concept that every long-term investor has to know. Corrections and crashes are the best opportunities. Warren Buffett even took the time out in 2008 to write his annual letter and actually address his declining investment portfolio. This does not bother Charlie Munger and I. Indeed, we enjoy such price declines if we have the funds available to increase our positions, which is just another reason to continue to dollar cost average and not time the market, because you never know when it's going to start to recover and you're going to want to continue to buy those stocks if they continue to crash. Which leads us perfectly into rule number 10. To wrap it all up, don't panic. All 9 of these rules should show you not to fear volatility, okay? It's great whenever stocks actually crash down because this is the time to actually buy in. And don't sell whenever these stocks are down, whenever, you're going to just become a statistic that retail investors underperform the market. Be the people that actually outperform the market. A rare breed of people that take a lot of temperament, patience, and consistency. Keep cash on hand and don't follow herd mentality, and watch out for the news around you because headlines can seem very dire, and then in that same day that bad news is posted, the stock market could be up. The stock market is an unpredictable beast, and it's very important, just like Warren Buffett has been doing for the last 80 years, is just to continue investing and be a net buyer of equities and other investments. But I urge you to look at the actual statistics of investing in a recession. You can check that out right here. But if you guys enjoyed the video, I'd appreciate a like and subscribe down below if you want to see more financial content just like this.